Good afternoon, everyone, and welcome to our webinar, GASB 87, Practical Considerations. I'm Janice Kaplan with the Marketing Department at James Moore & Company, and I'll be your host today. With me to present are James Moore managers Doug Gillikin and Wayne Durrett. Doug and Wayne combined for nearly 20 years of audit experience, with an emphasis on governmental, higher education, and nonprofit work. So they've worked extensively with clients whose funding is subject to government auditing standards, the Florida Single Audit Act, and OMB Uniform Grant Guidance. As you can imagine, they're great resources to cover this material today.
Good afternoon, everyone. Thank you for joining us again today in continuing our James Moore Summer CPE series. For those of you who participated in our GASB update back in May, we did work through GASB 87 at a high level, but today we're going to take a deeper dive. So first section of the webinar today, we're going to work through the pronouncement itself. We're going to highlight some key information as well as work through some real world examples, including going through the debits and credits for all you T-chart fans out there. After that, we're going to work through the implementation guide a little bit, 2019-03, which is specific to leases. We're going to cover various GASB 87 examples from the guide and hopefully clear up any uncertainties that you guys have with GASB 87. Finally, at the few minutes, we should have some time to go over some additional questions you may have. One other thing I just wanted to mention, I am presenting out of Tallahassee today, and we've got some weather moving through the area. So if you hear some feedback or anything like that, it's probably thunder. We're gonna work through it best we can. So let's get started. So what is GASB 87? Hopefully we all know by now the basic concept behind GASB 87 is to put leases that were previously known as capital leases on the statement of net position, previously known as operating leases on the statement of net position or the balance sheet, as you will. The GASB felt like this statement would better meet the informational needs of financial statement users. And GASB 87 is now effective for periods beginning after June 15th, 2021. So big thanks to GASB for coming out with GASB 95, which extended the effective date for many of the recent accounting pronouncements, including GASB 87. Unfortunately, we're just one vote short of getting 2 full years on that extension, but we'll take the 18-month extension we got. So as we touched on the previous slide, GASB 87, it's a comprehensive change to the way we're accounting for leases. Under the previous reporting model, we had 2 different types of leases. We had the capital and operating leases, in which leases that met the criteria for a capital lease were included in the statement of net position, while leases that did not meet that criteria defaulted to operating leases, which were not included on the statement of net position. So going forward, a lease is going to be a lease, and there's not going to be 2 different ways of recording. This is different from the GASB lease standard, which is still going to have 2 different types of leases, financing and operating leases. Under GASB, all leases are going to follow the same reporting model.
Yeah, Wayne, I don't think we can understate that we have to go through all this because FASB changed their lease requirements, and since FASB and GASB occupy the same building, GASB thought to themselves that was a great idea. So any and all frustrations can be pointed towards FASB.
Yeah, absolutely. So talking about the scope of GASB 87, it's going to be applied to any contract that meets the definition of a lease. And the definition of a lease, it's really important to focus on. So we're actually going to read the definition and dissect it a little bit. So definition of a lease, it's a contract that conveys the control of the right to use another entity's non-financial asset, the underlying asset, as specified in the contract for a period of time in an exchange or exchange-like transaction. So let's jump into that a little bit. So the 3 main points I'd like to focus on here are control of the right to use, period of time, and exchange-like transaction. So if you're missing any of those components when you're evaluating your contract, you don't have a lease. So to break down even further, let's talk about control of the right to use. So according to GASB 87, in order to satisfy this criteria for the definition, the potential lessor in this situation must have both the right to obtain the present service capacity of the asset and the right to determine the nature and manner of the use of the underlying asset. So if the government does not have the ability to determine the manner and use, you don't have a lease. So just to go into a quick example of this, let's say a situation where a government entered into an agreement to use another party's land for parking. However, the government in the example does not have the ability per the contract to determine who could park there. Since the government would not have the full right to determine the nature and manner of use in this situation, we would not have a lease. So let's talk about exchange or exchange-like transaction. Essentially, this means that the value exchanged between the parties is fairly equal. So there may be some situations in which judgment is required when evaluating if the exchange criteria is met. But the big one here is that those $1 land leases that many governments would have would be excluded from GASB 87, as this would not be considered an exchange transaction. Talking about the period of time criteria, this one's fairly straightforward. The agreement must have a definitive period of time in order to be considered a lease. So up next, we're going to go through our first polling question that I'm going to read through, and Janice is going to take us through the results.
Okay, here's our first polling question. Do easements meet the definition of a lease? Yes, no, or I don't know. And just a quick note, you may need to exit full screen mode to view the polling question. You should see it in a blue box. Go ahead and get your votes in. We'll give it about 10 more seconds. Okay, we're going to go ahead and close out the polling question. And let's see the results here. Looks like 61% of us said that easements do not meet the definition of a lease. My apologies. 18% say yes, and 21% say I don't know.
So a little bit of a trick question here. The answer is maybe, and we need a little bit more information before we can determine if the easement is considered a lease per GASB 87. So ultimately, it's going to come back down to what's in that underlying agreement or contract. And really, you have to apply it to that lease definition we talked about. So if an easement is permanent, it does not meet the definition of a lease, because remember, we had that period of time criteria. Furthermore, even if it's not permanent, we still need to have an exchange or exchange-like transaction in order for it to be considered a lease. So we need a little more information there to determine if it meets the definition of a lease. So short-term leases, good news, these are excluded from GASB 87. So any lease where the maximum possible term is 12 months, regardless of likelihood, those are going to be excluded from GASB 87.
Hey, Wade, I think we'll touch on it a little later, though, but keep in mind, I think everyone was thinking that 12-month period was going to be our out as far as implementing GASB 87. But as you guys will see later, excuse me, we'll talk about calculating the lease term, and even though the initial lease might be 12 months or less, there's some add-ons and things like that that'll extend the lease beyond that 12-month period. So we won't be able to just all do short-term leases like I think we were all hoping.
Absolutely. So yeah, just some more considerations when it comes to the lease term. Right off the bat, the lease term is going to include all non-cancelable periods plus any options to renew if it is reasonably certain that the option is going to be exercised. So as you can imagine, there's going to be some judgment required here when evaluating these contracts and determining if that lease option is reasonably certain to be exercised. Same thing applies when you're looking at lease termination options. You're going to include that period if it's reasonably certain the termination option is not going to be exercised. So moving forward, after that original lease term has been established, you're going to reassess the lease term if an option is exercised or not exercised that is contrary to the original expectation. So basically, if there's a change in from the original expectations, you're going to reassess that lease term. So moving into reporting on the lessee side. The lessee is going to recognize an intangible asset for the right to use the asset, as well as a liability for future payments. The asset is going to be amortized over time. So what amounts are going to be included in this liability? It's going to include fixed payments that are to be made over the lease term, variable payments that are based on an index or rate. You're going to use the rate that's in effect at the date of inception. Variable payments that are in substance fixed. Residual value guarantees if reasonably certain of being required. Any purchase options, including bargains, if reasonably certain of being exercised. Any termination penalties if the termination option was considered reasonably certain at the time of being exercised. Lease incentives. You're going to take all these items and you're going to discount them back to today's dollars. One other note here, the liability is not going to include any lease payments that are dependent on performance or usage. So an example of this would be an auto lease in which there's a base payment, but there's also an additional charge by mile. The base payment would be included in the lease liability, but any usage payments are going to be excluded from the liability. So the lease liability simplified, essentially you're going to take all the money that's going to be paid out over the term of the lease, other than any usage or maintenance charges, then you're going to discount it back to today's dollars.
Yeah, I think it'll be interesting to kind of calculate that out once we get into GASB 87. You know, you can't just do a one-size-fits-all calculation to get to that liability. I mean, we like to give you the answer, it depends, but in every situation, I think it will. I mean, every agreement is going to be different. All the terms are going to come into play now. So just read those agreements carefully and take everything into consideration when we start calculating those new lease liabilities.
Absolutely. So let's talk about the lease asset. What is going to be included in the lease asset? It's typically going to be all the items from the liability side, plus any prepayments prior to measurement of the liability, plus any initial direct costs that are needed to put the asset in service. Another item here, lease incentives are going to be counted as a reduction of the cost of the lease asset. Direct costs that are not related to putting the asset in service would be excluded from the cost of the leased asset. So initial direct costs should be expensed to their cost other than those that are used to be placing the asset in service. So like an example of this was if you had a lease agreement and there was maybe some sort of training component or some other charge that didn't have anything to do with putting the asset in service, this would be expensed and not as part of the lease asset. So moving on to the lessor side. The lessor is going to recognize the lease receivable as well as a deferred inflow of resources. The lessor is going to discount the lease receivable at the rate the lessor charges. The original asset that is being leased will continue to be depreciated unless it's part of something that's not typically depreciated, such as land, or if the asset is required to be returned in its original form. So the initial measurement of the lease receivable, it's going to include fixed payments to be made over the lease term, any variable payments based on an index or rate, using the rate in effect at the date of inception, any variable payments that are in substance fixed, any residual value guarantees that are in substance fixed. So some other considerations. As you all can imagine, many of these contracts we're going to be evaluating are going to include multiple components. So what you're going to have to do is you're going to have to break out which components are related to the lease versus any non-lease components of these contracts. So example of this, like we just talked about earlier, would be if there was some sort of service component, that's going to be separated from the lease component of the contract. And those would be treated as separate transactions. So lease changes, if you have a termination of a lease, you're going to write off the asset and the liability, record any gain or loss, any modification or changes in significant circumstances, you're going to remeasurement of the lease, and then you're going to change prospectively You're going to remeasure the asset as well, but you're not going to do any retrospective changes. If you've got a sublease situation, you're going to treat these as separate independent transactions. As we touched on earlier, these $1 land leases that many governments have, those are not going to be subject to GASB 87, as it doesn't meet the definition of a lease, as it's not an exchange or exchange-like transaction. So a few more considerations. So what discount rate should you use? You're going to use the explicit or implicit rate if it's available or in the contract. If it's not, you're going to use your incremental borrowing rate. So ongoing impacts, lease liability, you're going to amortize the discount as interest expense. Any payments that are received should first be applied to accrued interest and then to the lease liability. On the lease asset side, you're going to amortize in a systematic, rational manner. I prefer a straight line. For useful life, you're going to use the shorter of the lease term or the asset life.
Yeah, on that, the amortization, I don't think we still have any clear guidance on what to use there. So like Wayne said, straight line would be the easiest. I mean, you would think you could follow the amortization of your lease liability, as you're making those payments, come up with a rational way that works for you guys.
So on the governmental fund financial statements, in the year of the lease inception, you're going to recognize an expenditure and other financing source. So materiality considerations, there is no official de minimis threshold for GASB 87. However, you should consider setting some sort of internal policy similar to a capitalization policy for your organization. Just remember when you're trying to determine what is material, just to factor in the full impact of the lease asset and the liability, not just your monthly payments.
Yeah, and on the other side of that is, I think you need to determine what is significant to your organization. Every couple $1,000 copier lease, might fall underneath that threshold. And I wouldn't consider that to make your financial statements or note disclosures misleading in any way. So you don't want to go too low, you don't want to go too high. Just a lot of things to consider when you're, materiality is probably not the best term, but when you're setting that threshold.
All right, so next up, we're going to walk through a visual refresher, and then kind of at the same time, we're going to go through a real world example. So just looking at like the visual refresher, initial reporting on the lessee side under assets, the lessee is going to recognize an intangible asset, which is going to be, as we talked about before, it's going to be the value of the lease liability plus any prepayments, any initial direct costs that are used to put the asset in service. Still on the lessee side, looking at the liability, it's going to be the present value of the future lease payments. Moving on to the lessor side under assets, you're going to recognize a lease receivable, generally including the same items as the lease liability, and they're going to continue to report the original asset that's being leased. Also on the lessor side, you're going to recognize a deferred inflow. It's going to be equal to the lease receivable plus any cash received up front that relates to a future period.
I just really love that they threw in deferred inflows there. Like they created this new accounting term and they'll find any way to use it in any situation possible.
Gotta love it. All right, so here's where we're going to tie in our real world example as part of our visual refresher. So basic facts and circumstances. This is a road equipment lease. The term is a non-cancelable 60-month period with an option to extend 24 months. Management has determined that it's not likely they're going to extend. Under payment, you got a base payment of $1,000 a month. The base payment includes 200 hours of use of the equipment per month. There's going to be a $5 charge, additional charge for every additional hour used. management estimates that you're going to use 300 hours per month. In addition, there's a set $80 a month payment for repairs and maintenance. The rate that's stated in the lease contract is 4%. Some additional charges, there's an $800 charge for delivery, a $700 charge for installation, and a $500 initial training cost. So based on everything we've looked at, we've determined that this contract meets the definition of a lease. We've got that definite period of time that we talked about. We've got an exchange transaction, and then just for the purposes of this example, the government has the right to control the use of the asset. So we've identified we have a lease. What information is relevant to the lease? So the lease term is only going to be 60 months, even though there is an option to extend for 24 months, as there was determined that it's not likely to be renewed. So as we talked about earlier, that may take some judgment on behalf of management. So what is included in the lease liability? It's going to be the sum of all the base payments, $60,000, and it's going to be discounted by 4%. The excess use charge for those additional hours we talked about on the equipment is going to be excluded from the lease liability, even though management expects to incur these additional charges. Also, that $80 a month maintenance charge is going to be excluded from the lease liability, as that's not factored in as part of the lease contract. That's separate part of the contract. So what's included in the asset? It's everything we talked about on the liability side, plus the delivery and installation charges of $1,500, because these costs are necessary to get the asset placed into service. One note here is the $500 initial training charges are excluded, and that is also considered separate from the lease portion of the contract. So then, as you'll see here, we do have a difference here between the lease asset and the lease liability, and that difference is those delivery and installation charges. So here's the debits and credits in a T-chart format. So on the lessee side, you see that they've got the reduction in cash for those original delivery and installation charges. Those are being included in the lease asset, and the lease liability is really those future payments discounted into today's dollars. On the lessor side, really you see the opposite of this. You see the inflow of cash and recognizing revenue for the installation charges. You've got the lease receivable, which is equal to the lease liability on the lessee side, and then you've got your offsetting deferred inflow.
I think the key here, as Wayne's walking through the example, you can see how like little tweaks here and there in the wording really affect the dollar amount that you're going to record. So like we said earlier, just reread all your lease agreements or contracts and key in on some of those phrases that might include or exclude certain dollar amounts from the asset or the liability.
Yeah, absolutely. Just a small change can make a big difference in how it's recorded. So visual refresher, let's talk about some of the ongoing reporting. On the lessee side, under assets, you're going to amortize the intangible asset over the shorter of the useful life of the asset or the lease term. Still on the lessee side, under liabilities, you're going to reduce the liability by lease payments, less any amount for interest expense. On the lessor side of things, under assets, you're going to still depreciate the original asset that's being leased, unless it's something like land or the asset for the contract is to be returned in its original or enhanced condition. You're going to reduce the lease receivable by any lease payments received, but first you're going to apply those payments to any accrued interest that you have. Under the deferred inflow side, you're going to recognize revenue over the lease term. And so still sticking with our same example, let's look at the debits and credits with the transaction. So on the lessee side, get a $1,000 monthly base payment, a reduction in the lease liability offset by the interest expense. Lease asset, in this example, we're amortizing the lease asset using straight line. So moving over to the lessor side, you see they received the cash for the base payments, reduce the lease receivable. As you note, that number is the same, it's the opposite of what it is on the lease liability side from the lessees. Then you have the reduction of the deferred inflow and recognizing lease revenue and interest revenue below.
Yeah, I think the big thing here is that we're recording that asset now. I mean, I would assume most of us have made debt payments over the years. So, you know, I feel pretty confident on that side of the T account. The ongoing reporting shouldn't be the more difficult part. Like we said on that first example, you know, getting that lease liability or leased asset, you know, the total amount is going to be the tricky part. You know, from there, and then it's just systematic amortization of that amount. You know, we've all done that before. So make sure you want to get that first number right, the total amount, and then from there, you know, just normal amortization accounting.
Absolutely. So a couple other considerations here. For those governments out there that have debt, go ahead and start considering what effects GASB 87 is going to have on your debt covenants. Also recommend going ahead and starting to develop these policies for leases. You know, go ahead and define a threshold of what leases are going to be considered material for your organization. Define what reasonably certain means for determining those lease terms. Start developing procedures on how, you know, you're going to allocate these non-lease components and how they're going to be broken out from these contracts. And it's probably a good idea just to go ahead and keep this separate from your capital asset schedules, just for the ease. Other advice, definitely want to go ahead and start doing this now. Hopefully, many of you are already, you know, well on track to implement before GASB 95 extended the deadlines, but you know, for those of you who are, go ahead and take this opportunity of the extension to get this information together. And so that is going to take us into our next polling question.
Well, before we get there, Wayne, can I just add?
Yeah, go ahead, Doug.
On the bond and debt covenants, you know, we're pretty confident that the banks or loaning institutions are aware of GASB 87. I mean, they know it's coming, and that, you know, we're adding, you know, this new debt onto our books. But just keep in mind, like, you know, we're not sure what that number is going to look like yet. So, you know, definitely take a look at your covenants and talk to your bank about it, and almost give them kind of like your dirty first calculation of what that liability might look like, and you know, hopefully the bank will work with you, you know, with the new numbers, with the changes to your balance sheet. Hopefully the covenants themselves can get amended a little bit. And then on the starting points, like Wayne said, like, look at your financial statements already. I mean, the information is there in your notes or on the income statement as far as the rent expense or rent income if you're on the lessor side. But, you know, use the information you have already and then build on that to start looking at GASB 87. Don't think you have to recreate the wheel or, you know, start from scratch.
Yeah, absolutely. Taking a proactive approach is going to be better than, you know, waiting till the audited financial statements come out and you have to explain to your bank why your covenant ratios are all out of whack. So that takes us to our next polling question. I'll go ahead and read through it, and then Janice is going to take us through the results. So the question is, who is ready to implement GASB 87?
And you should see your polling question on the screen right now. The answers are, of course, bring it on, and can't wait. So it's in the blue box. If you can't see the blue box, please exit full screen mode. Maybe that'll help you see the polling question. We'll give you all about 10, 15 seconds to respond. Okay, gonna go ahead and close the poll out now. And here are the results. Obviously pretty straight across the board, 21%, 32%, 46% in that order. Wayne?
So just looking at those results, you can really tell that everyone's, there's just that overwhelming excitement out there when it comes to implementing GASB 87. And speaking of GASB 87 excitement, no one is more thrilled about GASB 87 than my good friend Doug. So I'm going to go ahead and turn it over to him as he takes us through the implementation guide. So Doug, it's all you. Doug, you on mute, buddy?
Sorry about that. Interesting to see those results on the questions. I think those answers were a little skewed, but I know everyone's going to be a GASB 87 guru after this webinar and is going to go out and change the world. But like Wayne said, I'm going to walk you through the implementation guide. For some of the bigger GASB pronouncements, they'll put together implementation guide. You can see it on the screen, that why, just to really provide extra guidance, clarify, explain, and elaborate on the requirements. So, for like GASB 67 and 68 on pensions, they put together an implementation guide. 74 and 75, they put together an implementation guide. For leases, we got one. So keep in mind that the implementation guide qualifies as authoritative guidance. So, after this webinar, I would highly recommend going out to the GASB site, downloading the implementation guide, and kind of reading through the examples that they have out there. Wayne, if you want to move forward one. So you can see there, basically the guide includes 77 questions and answers about GASB 87. The stakeholders of GASB submit these questions during that process, which you saw on the previous slide was almost a year. And they pick and choose what they feel are the less narrow questions that might apply to multiple situations. And then GASB themselves actually turns around and provides the answers. So we've got the 77 questions and answers, and then we just walked through actually one of the illustrations, but it provides 3 illustrations in the back of the guide, real world examples like Wayne just did for us, to hopefully you can find some similar situations in your own dealings. Use the guide to help you implement GASB 87. So what we're going to do now, though, we pulled out some, or what we felt like were pretty good questions to kind of walk through, just to kind of show you the information that's out there, available to you now. You're probably not going to find something exactly, the same exact situation you have at your company or organization, but hopefully you can kind of pick and choose the right information in the guide to kind of apply to your own situation. So Wayne, if you want to go to the first one. So 4.1, and like we said, there's 77 of these questions. So you can after this, if you download our presentation, then you can kind of come back and read the full answer based on the index that we have there. So the question is, the government obtains the right to use land, which has a market rent of $100,000 per year for $1 per year. Should the government apply the requirements in Statement 87 to that transaction? And like we said earlier, Wayne mentioned earlier, the answer is no. We talked about that since it's only for $1 per year, it doesn't meet the description of an exchange or an exchange-like transaction, and therefore you're not going to apply this lease using GASB 87. So then 4.8, I'm sure this is one that most governments are going to have to deal with, are cell phone tower or antenna placement agreements, leases. And keep in mind, these that for 4.1, 4.8, and 4.11 are all just about, does GASB 87 even apply to these situations? And the answer here is it depends. You know, that's our favorite answer. It depends on the control criterion in GASB 87, like Wayne kind of touched on. If the control criterion generally is met, if a cell phone tower or antenna placement agreement conveys control of the right to use the land on which the tower is placed or the connection point to which the antenna is affixed. So again, you kind of have to determine that control of the right to use the asset, and then you can kind of come back and say, does GASB 87 apply here? So the next one, 4.11. I like this one, and you'll see why in a minute. A government owns land that it leases to another entity for use as cropland. Is this lease excluded from GASB 87 as a lease of biological assets? And I don't think we really touched on this one yet, but interesting answer. So the answer is no, and in the answer they give us, although the use of the land for farming may produce biological assets, the underlying asset of the lease is the land, which is not a biological asset. So that I have a few issues with that answer. You know, how is land not a biological asset? But you can see, like we mentioned earlier, how just, you know, little tweaks in, you know, the wording or our, you know, what our situation is, how the agreement's written, you know, can make that difference. You know, when you go into this, you're thinking cropland, you know, of course that's a biological asset, but, you know, we're only looking at the land lease here, not what may come off that land. So just a little twist from GASB to keep us on our toes. So 4.12, so now we're getting into the lease term, like how to determine what the actual term is when we go to calculate the liability or the asset. So the question, a developer builds and leases a building to a government. The government is required to make payments during the 3-year construction period. The government does not have access to the building until a certificate of occupancy is issued at the end of the construction period. When does the lease term begin? So the key here is that certificate of occupancy, because they don't get it until after the construction period, the lease term won't start until you have that certificate in hand. So GASB says the lease term commences when the lessee has a non-cancelable right to use the underlying asset. So that tipping point then is that certificate of occupancy saying that, you know, the building is now yours. So moving on to 4.15, and again, we're still looking at the lease term here. A lease contract allows either party to unilaterally terminate the lease at any time, but also provides for cancellation penalties. The cancellation penalties are so great that it is reasonably certain that neither party will terminate the lease. Should the cancelable periods be excluded from the lease, or from the lease term, excuse me. So if you kind of think back, you know, kind of what we touched on earlier. So the answer here is yes. And the key is that unilaterally terminate the lease phrase that in the question. GASB goes on to say that periods for which both the lessee and the lessor have an option to terminate the lease without permission from the other party be excluded from the lease term as cancelable periods. The presence of cancellation penalties does not affect that conclusion. So just a little curveball there. Don't be swayed by extra information as you're going through your contracts or your agreements. So 4.16, pretty similar. And again, just to emphasize how just a slight tweak in the wording or in the agreement can change, the entire situation. So a lease contract allows only the lessee to unilaterally terminate the lease at any time, but also provides for cancellation penalties. The cancellation penalties are so great that it is reasonably certain that the lessee will not terminate the lease should the cancelable periods be excluded from the lease term. So if you think back on the previous example, we said either party, or the contract allows either party to unilaterally terminate. In this example, though, it's saying that only the lessee can terminate the lease. And so that changes the answer here to no, should the cancelable periods be excluded from the lease term. GASB states, the periods covered by either a lessee or a lessor option to terminate the lease be included in the lease term if it is reasonably certain, based on all relevant factors, that the lessee or lessor will not exercise the option. So because it's only one party in this example, you have to take that those termination periods into consideration. And then they go on to talk about how all relevant factors should be examined in determining the lease term. And so those cancellation penalties, whereas in the previous example, should not have been considered in the determination, in this one, they should come in, or they should come into play as a factor when you're determining that lease term. So again, just to re-emphasize, when you're going through these agreements, those little tweaks in the wording or in the agreements themselves can really make a big difference. So take some time, read through them slowly, read through them carefully, make sure you understand all these little nuances that can change the lease term, that can change the lease liability. So the next one, which I think Wayne did a good job of covering this one. So we're looking at short-term leases here. A government enters into his 12-month non-cancelable lease in which the lessee has options to renew for 12 months at a time, up to 49 times. Is this agreement a short-term lease under GASB 87? Excuse me. And the answer is, of course, no. Like we talked about, with that, the option to extend 49 times, blows that 12-month or less requirement out of the water. And so you'll have to use GASB 87 or track this lease under GASB 87. Like we said earlier, when they first came out with GASB 87, I remember everyone thinking, we'll just switch to short-term leases and do all our agreements under 12 months, and we'll just keep renewing them that way. But as you can see here, GASB, pretty much squashed that right away. So moving on to 4.23, and here the questions are really looking at determination of the lease liability. But I wanted to highlight this one. We kind of talked about it earlier, just to talk about the capitalization threshold. But the question is, the government adopts a capitalization threshold and expenses acquisitions, including lease assets that fall below that threshold. Can the government apply a similar threshold to lease liabilities? And GASB goes on to say, authoritative pronouncements do not provide specific guidance related to a determination of capitalization threshold amounts. However, governments often establish capitalization thresholds. So really they're putting the onus on us to kind of come up with that capitalization threshold or methodology, if you will. Like Wayne stated earlier, whatever works for your organization, I think as long as you can justify that method or that threshold, excuse me, go with it until GASB tells us otherwise. We're kind of on our own on this one. And then I'm going to skip ahead a little bit. So 4.31, I'm still under the lease liability section. I'm going to skip a lot of these. They're great examples, but like we said earlier, there's just so many factors that play into calculating that lease liability. I'll recommend to you guys that you again download the guide and read through some of these examples as you're going through GASB 87 yourselves. But wanted to highlight 431. Wayne touched on it a little bit, but I figured it was worth re-emphasizing. So the question is, a government leases a fleet of vehicles for half of the vehicle's estimated useful lives. The lease term is 30 months. The lease does not specify the discount rate. Total monthly lease payments over the term of the lease are 1.1 million, and the fair value of the vehicles at the commencement of the lease is 2 million. May the fair value of the vehicles be used in determining the implicit discount rate of the lease? So the answer here is yes. Like Wayne pointed out, you need that discount rate to come up with your lease liability. GASB goes on to say here, discounting the lease payments at the rate of the lessor charges the lessee explicitly or implicitly arrives at the fair value of the right to use the vehicles, which is not necessarily equivalent to the fair value of the vehicles. So just kind of a roundabout way there to say that you can kind of come up with, if it's not explicitly, the rate is not explicitly stated in the agreement, use that fair value of the underlying assets or those right to use assets to kind of come up with your own discount rate so you can implement the changes for GASB 87. So just a couple more for you guys. So now I'm looking at the notes to the financial statements for lessees. So the question here is, can amortization expense for lease assets be combined with depreciation expense in the required disclosure by function? So we're looking at our note disclosures right now. Can we lump the amortization expense in with our depreciation expense? So the answer is yes. GASB says that the lease amortization expense by function should be disclosed and may be combined with depreciation expense in the required disclosure by function. So like Wayne said earlier, you want to track these assets separately, from your normal capital assets. For reporting purposes, they're going to go to different places on your financial statements. But when we're talking about, the disclosures and when we roll up to just those certain line items, go ahead and combine the two just to make your life a little easier. So then 4.49. Now I'm in the lease receivables section of the guide, and again, same as the lease liability side. For the lessors, again, there's great examples in here. I'd highly encourage you to come read through some of these, see if you can pick and choose situations that work for your organizations. But one I just wanted to highlight here. So the question is, can methodologies other than the interest method, such as straight line amortization, be used to amortize the discount on lease receivables? And contrary to we were talking about you know, the lease liability, and you kind of can come up with your own methodology. Here on the discount on the lease liability receivables, GASB just says no. Lease receivables should be amortizing using the interest method. So just to take any guesswork out of it, they actually gave us a nice definitive answer here. And then finally, the last one I wanted to bring up with you guys, I'm looking at the lessor section of the guide. So just bear with me, longer question. A government leases one floor of an office building to a private party for several years. In the middle of the lease, a significant downturn in the local real estate market occurs. The government and the lessee renegotiate the rental payments for the remainder of the lease. The lease receivable, the present value of lease payments, was expected to be received during the remaining lease term. Before the amendment was $500,000, and after it was $270,000. Excuse me. How should the government account for the lease modification? Quick drink. So the answer is that the lessor should account for a lease modification by remeasuring the lease receivable. So what we're going to do here is we're going to decrease the lease receivable and the deferred inflow of resources by, you know, the difference from the 500 to the 270. So we're going to decrease it by 230,000. Like Wayne kind of talked about, anytime there's, you know, a change in your lease, you kind of have to determine if it's going to be a lease modification or if, you know, we have just a totally new lease agreement. So in this one, we're going to keep going with the same lease with the same amortization. We're just going to treat it as a modification rather than pretty much starting over with a new receivable and new term. So if you want to go one more, I just wanted to, well, go back. There we go. So the guide kind of ends with some, you can see here, some pretty specific areas to talk about. So lease termination, sale leaseback, lease leaseback transactions, and then intra-entity leases. You know, pretty specific, and you know, I didn't think it would really apply to a lot of us out there. But again, just wanted to point out that the guidance is there. If you guys have these transactions, again, come out here to the guidance and see, you know, the questions that got asked, but you know, really just GASB's answer to those questions. I think the other important key is that GASB is pretty good about responding to inquiries. I think 77 questions and answer was one of the bigger guides that GASB ever put together. So obviously, you know, this is a big statement to implement. You know, don't feel like you live on an island. You know, go to GASB, ask them directly, you know, get their thoughts so, you know, you have it straight from the horse's mouth. Or talk to your auditors. You know, chances are that they're going to deal with this, you know, across multiple clients. They're going to be helping a lot of people. You know, sometimes your organization, you're doing it once and that's it. So hopefully, you know, just for the sake of experience, they might have looked at this more than you guys. So, and then the final thing, you know, we talked about those illustrations. You know, come out there and look at them. Wayne walked us through the one like we talked about. There's two others in the back of the guide, one about lessee reporting, and then one about variable payments. You know, it's definitely worth coming out to the guide, you know, quick read through, see if, you know, some of the situations that you're going through or some of your current lease agreements, you know, match some of the issues that they're talking about here. You know, it's just the guide is just a great resource for you guys moving forward as you start looking at GASB 87. And I think we have a polling question coming up, right, Wayne? Yeah, there we go. So the question is, have you read the implementation guide for situations similar to your own? I guess I should have said yet there, but.
Here we go. Again, if you can't see the polling question, you may need to exit full screen mode. Yes, no, or what's an implementation guide? While we're waiting, we have a joke to share with you. Why do ghosts love the new lease accounting standards? They increase transparency. I can hear your groans all the way over here.
I prefer Brendan's dad jokes, but that'll do for now.
One is from Brendan. Okay, give me a few more seconds. And we'll close out the poll now. And let's see the results. We have 42% say yes, they have read the implementation guide for situations similar to their own. 50% said no, and 8% asked, what's an implementation guide? There you go.
Well, for the 42% of you kudos, you're ahead of the bar. For the 50% of you that haven't gone out there yet, again, I can't stress it enough. Please go out to the GASB site after this webinar, download the guide. Look through some of those questions. They're, like I was pointing out, the different sections in there. Go to the part that you're questioning. See what's out there already, before you start implementing GASB 87 on your own. And these are real live questions that people sent to, or stakeholders sent to GASB. These aren't just GASB made them up in a vacuum. So highly recommend going out there and reading through this guide. And then to the 8% of you that still don't know what an implementation guide is, I'm assuming those are my James Moore cohorts just giving me a hard time, but hopefully you know a little more about GASB 87 and the implementation guide after this webinar. But I think we have some questions, don't we?
We do. We have a handful of them, actually, so we'll get right to it. The first one came in as we covered initial reporting examples, and it said, in this example, what if either party can cancel at any time, so no longer non-cancelable? Would that meet the definition of short-term lease?
I don't think it would necessarily be considered a short-term lease, but if either party does have the option to cancel at any time, then that period of the non-cancelable portion would not be included. If they could cancel at any time, that would not be included. That portion of the lease term would not be included as part of the lease. I think Doug went over an example that had a similar situation from the implementation guide.
Yeah, so keep in mind, if the two examples we looked at 4.15 and 4.16, 4.15, the contract allowed for either party to terminate the lease, versus 16, it talks about only the lessee could terminate the lease. So, you have to kind of read it carefully and make sure that certain situation applies. But like with 15, where both parties could terminate the lease, the cancelable periods were excluded from the lease term. Where only the lessee could terminate, the cancelable periods were included in the lease term.
Okay, we're ready for the next question then. How do you account for leases that payments are made quarterly? These quarterly lease payments.
I think ultimately it would still end up being the same as far as when you're figuring out what that lease liability is going to be, and then just as the ongoing reporting, the big difference there is the payment would be coming in quarterly, so that's when you'd be making your adjustments. But overall, I don't think it would really change too much as far as the way the initial and ongoing reporting is.
Yeah, I think most of the examples GASB gives us is on a monthly basis, but like Wayne just said, the fact that it's quarterly, you're still going to recognize it in the same manner.
Okay, and one more. We have, well, a few more. One of them is, how can you provide an example of how to account for copier leases?
So as far as a copier lease, I mean, first of all, you'd have to look at the underlying agreement and then the contract, making sure that it actually does meet the definition of a lease. And if it does meet the definition of a lease, and you determine that this lease is material to your organization, you need to apply GASB 87, then you would go through the same methodology that we went through during the presentation.
Yeah, definitely, go back and look at the example that Wayne walked us through. That's the first illustration in the guide, lessee reporting of an equipment lease. So, I mean, I think, copier lease would definitely be a similar situation.
Yeah, absolutely. As Doug said, the example we walked through earlier, I took it, it's not exactly what's in the implementation guide for illustration, but it's very similar. I mixed it up just a little bit, but if you wanted to see the detailed example of that, you could follow the illustration guide.
Okay, sorry, my mute was on there. So we've got another question. Do you think most entities will use the capitalization threshold as their lease threshold for materiality purposes? And should they, or should those amounts be different?
It depends, I think, is the official answer. I think you start with your capitalization threshold, to kind of give you an idea of what the numbers would look like. Hopefully for most organizations, you're at least at like a 5,000 capitalization threshold. Like Wayne said earlier, though, you don't just look at the monthly payments. Look at the whole lease agreement, or the total amount of your asset and liability. That's where the materiality level comes into play. You have to look at your organization as a whole to kind of come up with that materiality number, or that de minimis threshold. Like Wayne said earlier, you don't want to go too high or too low. You kind of have to figure it out what's going to work best for you guys, so you're not capitalizing every small lease that you have, every 2-year term, for your copier that's $3,000, but at the same time you don't want to go too high and you're almost capturing no leases. So I hate to say it depends, but that may be the best we can do right now without seeing the agreements themselves.
Okay, we have a couple more questions. Let's see, our lease agreements have annual opt-out options, but typically remain in effect for 5 to 10 years. How does GASB 87 apply?
So remember we talked earlier about the lease term, and if there's those optional renewal periods, that's where you're going to have to apply that reasonably certain language that GASB gives us, where you're going to have to maybe use some judgment and determining those options that are reasonably certain. And if they are reasonably certain, then those periods would need to be included within the lease term.
Okay, we've got one more here. Any suggestions as to what basis we should use to decide whether or not certain leases are considered de minimis?
Can you repeat it one more time for me, Janice? Sorry.
Sure, let me get back to it over here. Any suggestions as to what basis we should use to decide whether or not certain leases are considered de minimis?
Okay, I think that ties into the question that Doug answered earlier about, really we're looking at a materiality or some sort of, threshold of which ones need to be capitalized and or not. Unfortunately, the answer is it really depends on your organization.
Yeah, I mean, without, in a vacuum, it's kind of hard to define what you would consider de minimis. Start with that capitalization threshold, talk to your auditors, kind of, where they would feel comfortable with, a threshold to leave off the less significant leases. Just the sheer number of lease activity that you have going on, I think will come into play there too. But yeah, I mean, it's going to be entity by entity to kind of come up with that level.
Okay, we did get a couple more last minute questions come in, so I'm going to go ahead and ask them too. If the lease is a lease of an office space in a building and the lessee can only use it for office work, they can't, in other words, they can't use it for anything they want, just office work. Is that a lease? Does it meet the right to control?
So that's a good question. I think, really you have to look at what that asset is intended for. Obviously there could be some sort of restrictions on, like in this situation, I think you have to really factor in like what the asset is and what is it typically used for. And if the contract restricted, something that was, typically what that asset was used for, then obviously it would not meet that criteria for the right to use. But I think, that's a good question. I think in that situation, it still would qualify as a lease. Doug, do you have anything to add to that?
Yeah, not really. I mean, again, I'd have to look at the agreement and kind of, read the wording in there. It's tough to say, what that right to use looks like right here.
Yeah, like I think in that situation, like, if they, rent an office and, typically that space is used for office purposes only, but, they were restricted on, having a bonfire in the office, I don't think that would be something that would disqualify from, these criteria right to use. So may have to use a little bit of judgment there, but I don't think that was like the intended purpose was to get out of GASB 87 with, certain restrictions that were, just kind of basic understandings.
Okay, and one more question. We'll close it out with this one. Do you foresee governments including their lease threshold as a note disclosure, similar to cap threshold?
I don't think so. I think that's just going to be an internal policy. I think that it's really just for, ease of mind, really, that we're talking about a materiality level. I think GASB would disagree wholeheartedly with using materiality, but I mean, if you don't, you're going to end up using or wasting so much time trying to figure this out for every insignificant lease that you have. So, again, start with your capitalization threshold as a good starting point, and then kind of go from there to where you are comfortable setting that materiality threshold for implementing GASB 87.
Yeah, I agree with Doug. Just like this, the GASB, says there's no official like de minimis threshold. So really, the only reason you're not going to be capitalizing a lease in some situation is that you've determined it's not material. So I don't think disclosure of that would be necessary.
Yeah, and I think that's, similar to what we're doing now. I mean, if you look at your financial statements, like we were talking about your operating lease note right now, I'm sure that disclosure doesn't include every little lease that you have. You're just focusing on those significant lease agreements that you have, that would actually sway the readers of your financial statements. So, just because we're switching to GASB 87, I don't think that thought process changes.
Okay, well, that's all for the questions that we have today. And Doug and Wayne, thank you so much for your time. You've given us a lot to think about with this webinar. Now, if anyone still has questions on today's topic, please feel free to contact Doug or Wayne with any questions or concerns. They're more than happy to help. Our final webinar in the 2020 Government CPE series is a week from today on July 22nd at 2 p.m. You can see the details on your screen there. We'll be providing an update on single audits and Yellow Book guidelines. You can register for that webinar using the link on your screen. And that's all we have for today. Thank you once again for attending our webinar. Have a great day.